Monet, it's so great to have you on the DeFi and Data things we've ever had the pleasure. So I'm glad it's in this setting.
Yeah. Thank you for having me on.
Yeah, of course. All right, so we're at this crucial moment in DeFi where it seems that institutions have just started to dip their toes, test the waters. Um, how does Spark fit into this? Like, what is the offering? What's kind of the pitch for institutions?
Yeah, we have we have a few like sort of core product offerings that I think are a really good fit for institutions. Firstly, we have a blue chip lending market called Sparkland, which has like a really restricted sort of blue chip only collateral focus. So it's I would say in many ways like the safest DeFi lending market compared to some other peers that have a little bit more like long tail exotic collateral assets. And then we also offer a savings and like treasury managed product called Spark Savings, which has like a diversified collateral backing and is able to deliver like industry leading yields at scale while also keeping the risk in check. And yeah, I think that's, it's a good fit for institutions. I think they want to have managed sort of low risk products that have the scale they need to like get in and out at a, nine figure size.
For institutions, obviously, compliance and privacy are top of mind. So, in this kind of blue chip product for institutions, how do you address those?
Yeah, privacy is challenging in a DeFi context. One thing that we're tooling up for though is being able to serve institutions in custodians, which is in a lot of cases institutions prefer doing like sort of over-the-counter lending arrangements and custodians because it gives them, they're already comfortable with custody risk from someone like an Anchorage, but it also gives them privacy. People aren't necessarily seeing exactly what collateral they're posting for the loans, how much they're borrowing. So I think having more options like that where we can meet institutions in the sort of products and structures where they're already comfortable is a big unlock. And that's something that is kind of uniquely enabled by Spark's liquidity layer infrastructure, where not only can we put money into DeFi opportunities, but we can also put money into sort of like RWA and more like CeFi opportunities as well.
So when we talk about institutions, there's obviously many kinds of institutions. So where you're seeing demand for your lending products, is it more like crypto native companies that want to put their treasuries and get some sort of yield, or more like crypto custodians, or maybe hedge funds? Like what kind of institutions are you seeing more demand from?
Yeah, it's a big mix. I think some of our earliest large-scale users have been like crypto native hedge funds, where either they're parking some money overnight or over the weekend with us just to like continue to earn yield on their idle positions when they're between trades, or in many cases they have a big portfolio of Bitcoin, Ether, and they're financing that via Sparkland. So those are kind of the early adopters. They're comfortable operating on chain. What we're seeing as like sort of the next wave though is fintechs, custodians, wallets, people who are running essentially earn programs on behalf of their end users, as well as borrow programs, stuff like this Coinbase Bitcoin-backed loan product. They've had great success with this using Morpho infrastructure with Spark as one of the primary liquidity providers. So we think that there's a lot we can do to support kind of more of like a B to B to C sort of structure where there's institutions that have really great distribution and then we can plug in with capital and sort of this infrastructure layer.
It's interesting. So on one hand, there's Spark is offering the ability for institutions to deposit funds and earn yield, but now you're also talking about the possibility of integrating with, for example, a fintech for distribution.
Yes, yeah, exactly. And some of them are like taking this sort of as like a fully intermediary, like they're like the principal. So like the users are getting yield from the fintech and then we're providing it on the back end. In other cases, they're using interesting like sort of passkey wallets or new technologies where it's still like a non-custodial service, but it has familiar like Web 2 UX. So it's kind of like the
Interesting.
DeFi mullet stuff that people talk about.
Mm-hmm.
So yeah, a lot of different approaches, but we're happy to kind of meet these institutions wherever they are and what sort of product experience they're trying to deliver.
Um, I think always in DeFi, but especially because of like recent hacks and events, uh, risk is top of mind with lending. Um, what would you say distinguishes Spark in this area?
So I think we have a very patient approach to risk management. Like we are always on the lookout for new opportunities, including ones that, have maybe a bit higher risk profile, but it's matched with a higher reward. But we take a very sort of conservative view, making sure that we're always being compensated for the risks that we're taking and that we don't have too much concentration risk with any one sort of more longer tail opportunity so that our capital is always going to be sufficient to cover it in case something goes wrong. So yeah, I mean, we have the luxury of taking a more patient approach because we are part of the Sky ecosystem. It's like one of the most lindy and trusted DeFi protocols. We have a really high quality capital base from Sky. So we're able to sort of just take the sort of lower risk opportunities and still drive a business out of that. So yeah, we're in a good position where we have the ability to be patient when some others, they almost feel like they have to be chasing high yield irrespective of the risk because how else do you differentiate? Um, so yeah, I think just patience and having like a really firm approach to risk adjusted return.
Um, how do you evaluate what collateral goes into the protocol?
Yeah, it's a pretty rigorous process. So we do a lot of like fundamental research as the starting points. Identifying all of the custody and admin risks, all the different smart contracts that are involved, whether some of these assets or protocols have like dependencies below them that we're also underwriting. Do like a lot of research like this. All this is open sourced as well. We publish our research on the Sky forum. After that, once we've kind of taken like the go no go decision, if this asset meets our requirements, it's like fundamentally secure. Then we consider all the different risk factors, evaluating the likelihood of different risk events happening per type, and then how much of a haircut we might take in those sort of circumstances, and we are able to kind of get like essentially like a hurdle rate of how much we expect of a annualized loss on the asset in a worst case scenario. And then we bake that into our allocation framework. So we're only going to allocate to an asset if the excess, return that it's generating justifies that expected loss, that risk that we're taking. So we're always kind of balancing these different opportunities against each other. Sometimes if the yield goes a little bit down on one opportunity, even if we still have like a spread versus our cost of capital, we'll pull out funds if it's not providing like a risk-adjusted adequate return.
And um, because in the case of Spark, you don't have like segregated collateral, right? All collateral is part of the same liquidity pool, right?
So a little column A, column B. So Spark Lend is it's like a sort of integrated like mono pool lending market where all the collaterals are usable together in positions to borrow any of the borrowable assets. I'll note that many of our collateral assets cannot be borrowed, so there's a little bit less like sort of rehypothecation risk than you'll see in a typical lending market, but it is still all kind of part of a unified market. So we really don't want to allow any high risk assets in that pool because it has more of a contagion risk. The other part of our protocol, though, Spark Liquidity Layer, we kind of act as like the risk curator and we individually allocate to different opportunities. So some to Sparkland, but then maybe some to Maple, some to Morpho, various different places. And we have a lot more fine-grained control of how much we're putting where, and there's no like cross-contamination between those. So we're able to take go into a little bit more interesting of opportunities, so to speak, with the isolated Spark liquidity.
So in that case, I guess like the difference between Spark and Morpho and Euler is that Spark is a curator for this different collateral vault, while in Morpho, Euler, and others, there's it's a more kind of distributed or like decentralized, if you want. There's like different curators that might have like different risk profiles.
Yes. So like at Spark, in a sense, it's like we're vertically integrated. So we have the infrastructure layer, the Spark liquidity layer protocol, and then we also act as the risk curator for Spark. I guess the other difference is that it's like a meta curator essentially. So we're allocating to Morpho, to, we don't have anything in Euler now, but in the future we might, to Euler, to Sparkland, to Aave, anywhere else that's a good opportunity. So it's like at one higher level of abstraction versus Morpho vaults, where presently at least, like you're allocating just across Morpho pools.
Right.
In the future though, I mean, there's nothing stopping us from allocating into a vault run by Gauntlet or any other sort of third-party curator. It's just not something that we've done up to date, because we can cut out like a layer of cost if we just do it ourselves.
Interesting. So, okay, so after what happened with Stream, do you think like what's kind of the big takeaway from you in how these lending markets should be structured? Like any kind of lessons from what happened?
Yeah. So I guess first and foremost, like you have to do proper due diligence on each collateral asset you're underwriting. So Stream, we never really even considered it as an asset, but we have had similar kind of more off-chain hedge fund style products approach us and ask to be listed. And it's not really something that we're keen on, because the transparency is not really there, and you just never know what strategies they're pursuing. So I think that's like step one, is just do the right DD and make sure that it's aligned with your kind of risk tolerance, your risk preference. Yeah, I think honestly I would say that's mainly
the main thing. But you don't think there's anything wrong with like the vault curator model per se?
There were a lot of comments at the time, because there was sort of a generalized like liquidity crunch. Like everyone wanted to pull out of high risk vaults on the Morpho ecosystem. I don't necessarily think that was actually much of a problem, because for most of these vaults, if they didn't have a direct exposure to stream finance or to DEUSD or some of the other like actually impaired assets, they never fully lost liquidity for the most part, maybe just for moments. But for your average user who had tens, hundreds of thousands in there, like typically you're able to withdraw immediately, and then you were earning quite a great yield. Like for a couple of days, people were earning 30% APY. So I think it's it's a wake-up call that you have to be underwriting collaterals properly. But I don't think there was actually like a vault-to-vault contagion like people had sort of mentioned. I think for the vault curators that did a good job, and they they weren't directly exposed, it ended up being fine for them. And their users, maybe they were feeling a little bit uneasy for a while, just generally wanting to risk off. But for the rest of the curators, I think it worked okay. We have vaults, in various places in Morpho, but no exposure to long tail like crazy assets, and for us it was not an issue.
And then to wrap up with Spark, what's going to be your main focus area in the next few months?
We've got a few irons in the fire. So we have our Spark savings products, which are kind of like basically generally taking the yield sources from the Spark liquidity layer and providing it to end users, whether that's individuals or institutions. We really want to drive growth on that, on Ethereum, via distribution partners on other chains. We have a interesting new product called Spark Prime, which is going to help serve these hedge fund clients who want to do kind of more delta neutral strategies in a way that's both very secure for us, but then also provides them sort of unrivaled capital efficiency. So I think that's going to be a big unlock, and in a way it can help kind of avoid some of these stream finance situations if we have a safer way to finance this delta neutral activity. And then other than that, just kind of continuing to grind on Spark liquidity layer and Sparkland, and just optimizing and making these products better and better.
Do you foresee having a Spark app?
You know, it's something that we are actively exploring. We want to make sure if we launch a Spark app that it provides, like, it has a, you know, a unique selling point that are going to make people want to use Spark app among the sea of new sort of neobank offerings, which for the most part I view as undifferentiated, and I think most of them are probably going to be a money loser. So yeah, we're looking into it. If we think that we can make a really compelling offering, then we'll absolutely ship it.
Interesting. All right. Well, Monet, thank you so much. That was great.
Yeah, thank you.